pre-tax cost of the following debt? A 10% coupon irredeemable debenture trading at 80 naira x int. What does that mean? The debt is what? The debt is irredeemable and it's traded. So of course there's always interest. There's interest and there's market value. You already know that the cost of debt, example 1, KD is equal to post-tax interest over market value. They already know that the market value is X int. So not that you now come and start moving interest rate again. It's X int already. So your interest is what? This is coupon. A 10% coupon irredeemable debenture trading at, pay attention. See, trading at what? Market value of 80. Now, how do you get this coupon? You know it's 10%. So your coupon will be 10% times 100. I told you in my explanation that those debts are usually at 100. That's the face value. So this coupon is 10% of 100 and that will give you 10, right? 10 naira. You get. So they've already said that this one is trading at what? 80 naira. So that's 10 naira. You know, they asked me where's your 1 minus t. They didn't give you tax rate in this question. And they even said estimate the current estimate the current pre-tax cost. Pre-tax, not post-tax. So they are saying this cost of debt itself is pre-tax. So if it's pre-tax, you can't be put lesson tax now. And another clue again is that they didn't give you tax rates. When you know one question, they give you tax rate. This one is just helping us to test the formula. So you have 10 divided by 80, and that will give you 10 divided by 80, that's 1 over 8, and that's like 12.5%. Yeah. So let's move to the second example, which also gives us another scenario. So this question says, estimate the pre-tax cost of the following debt. A 12% coupon, irredeemable debenture trading at par. Now, trading at par. At par with what? That is at par with the face value. There's always a face value of debt. I told you guys now. There's always a face value of debt, and there's always a market value, right? Market value is what it is trading at. Most times, I think it's the face value. They always report in the financial statement. Do you understand? Just like I think it's just like you see some assets at in the financial statement, you see those assets at 1 million. Maybe they bought it like years ago, but now in the market it can't be 1 million if you want to get a new one of it. So what is the value in the market? It's always different from the face value. So now they're telling you that a 12% coupon, 12% coupon, I is equal to 12% times 100. This is always the face value of the debt. Every debt, 100 face value. SFM, the best I know is always 100, except it is otherwise stated. So you have 12 naira. That's the coupon. This is what is always paid to the debt holder, right? Annually. Trading at par. What is the market value? When you see trading at, that's what is the value in the market. Okay, so at par means at 100. At par, the same thing. You could trade at a discount. Look at this one. It's not really trading at. It's trading at a discount. Can you see? It's trading at a discount. It's trading less than par, less than 100. And this tells you that whenever a debt is trading at, discount, the coupon will always be less than the cost of debt. So this is even the way, I don't want to come into all these rules, but this is the way to know if your answer is correct. See, if a debt is trading at par, we'll go there. The coupon will always be equal to the cost of debt. If a debt is trading at premium, the coupon will always be greater than the cost of debt. You don't have to learn all this one, it's just something that you notice over time. So it will not be a way to know if your answer is right or wrong. It does if you need it, but once you know you are solving correctly, you don't need it. So this one, 12 over 100, will give us 12%. Can you see that the cost of debt is the same thing as the coupon rate? Let's go to the next question. It said a 10% coupon irredeemable debenture trading at 105. 105 is higher than par. It's trading at a premium. That is the market value of that debt is a premium. Can you see that? At that rate, the coupon will be greater than the cost of debt. That is what the debt holder is receiving as monthly interest is even higher than the estimated cost of debt. That's true. Have you ever thought of it that what's the difference between coupon and cost of debt? Because if somebody is receiving this amount, if somebody is receiving this one annually, right, as interest rate, then what are we using cost of debt for? Cost of debt is just for evaluation purposes, right? So it's not an investment appraisal. You now kind of see the necessity, and that's because of time value of money. I think it's the time value of money that gives rise to all these issues of you knowing that 1,000 naira today on the date of an agreement or on the date of an investment does not mean 1,000 naira in 5 years time. So because you need to discount, right? You need to discount cash flows, expected cash flows. That's why you need all this cost of debt, all this cost of everything. But this rate is what the debt holder receives. So all these ones are more like theoretical variables, if that makes sense. English is hard. So here, your interest, that is your coupon, will be what? 10%. 10% redeemable debenture. 10% times 100, that will give you 10 naira, right? So your KD will be what? That will give you 10 naira. So your KD is 10 naira over, it's trading at 105 x in. So you don't need to remove interest. So 10 divided by 105, that will give me 9.52%. So if you put 10 over 905 in your calculator, you know you get 0.0, you get 0.095. So if you guys know how to move, just move by 2. Or just multiply by 100. Multiply by 100, so you have 9.52%. But if you're good with numbers, you just like move by 2. So you have 9.52%. See, cost of debt 9.52. Is it not less than coupon rate of 10%? It's less. It's less. So let's go to another example, right? Question 4. We're going to solve a lot of questions up to 8 or 9. So question 4. Calculate the pre-tax cost of debt for a 10% redeemable debenture. The ones we saw earlier are what? Irredeemable. Now, a redeemable, it means there's an amount to be repaid. There's repayment of principal, right? A redeemable debenture trading at 74 naira. A 10%, this is coupon, redeemable debenture trading at 74 naira. See, it is trading at a discount because it is less than the face value. I said the face value in SFM most times is 100 naira, except if otherwise stated, but most times 100 naira. So trading at 74 naira, this with 3 years to redemption at par. That is after 3 years, the company will pay back that principal at par. That is at 100 naira. 100 naira is par. Don't forget. So this one should tell you that this is a redeemable and traded debt. That's market value. So you use IRR. Don't forget the formula for IRR. I told you that the formula for IRR is what? Lower discount rate plus MPV of the lower discount rate over MPV of lower discount rate minus MPV of higher discount rate into higher discount rate minus lower discount rate. It is very simple. Now, how do you get all these variables? You go and describe what happens to the debt holder, that is the investor, the owner of the money. Do you understand? Don't forget I said in cost of capital, we look at things from the point of view of the investor. This is one time that lecturers will not mention in class. You have to figure that one out by yourself. But I'm giving you guys for free, so give my video a thumbs up. So, the scenario they explain for you, you put it into a tabular form. Year 0, that is on that date that the debt will be issued, on that date, on a date today. In SFM, year 0 is always called today. So just write details, that's what's happening. So just write details. Write cash flows. Then write discounting factor. You discount, then you get your present value. If you want to understand, you get your present value. Okay? So in year 0, what's going to happen? The market value for the debt will be paid, which is how much? 74 naira. So 74 naira is coming out. Does it make sense? From the point of view of the investor, we are trying to determine IRR because IRR is the cost of debt for a redeemable and traded debt. So the discount factor will always be at the coupon rate, 10%. So this one will be assumed, so you always start from here. So this one, you don't know whether it is the lower rate or the higher rate until you get your NPV. So just keep following the class. So let me take my calculator. So discount factor at 10%. Now discount factor is what you use to multiply the cash flow to give you present value. Oh my god. Present value, right? Present value means you are discounting a future amount. If you want to understand the concept of present value and future value, there's a video on my channel. I'll link it up here. So you can go and watch it after this one. It's very simple. I explain it in simple terms. So this discount factor, what you need to do is to put in your calculator 1 plus 0.1, which is 10%, right? Raised to power what? Number of years, that's 0. And you get 1.00, just 1. So that formula for discount factor, to get that discount factor, like multiply by this, just say 1 plus r raised to power minus n. 1 plus r raised to power minus n. In that video, I broke this thing down. That video that helps you to convert from present value to future value. So, right? So let's still continue with what is happening. Now in year 1 to 3, I think we said it's redeemable in 3 years, right? It's redeemable in how many years? Redeemable in 3 years. But between year 1 and year 3, the debt holder, the investor, will collect coupon, right? You will collect interest. So write the interest here. Does it make sense? And that interest is what? 10% of the par value of debt. So coupon is always calculated, or interest is always calculated on par value. So that would be 10 naira. Do you understand? Now, it's for 1 to 3 years, for 3 years. So for this one, you can check your annuity table. I'll put it on the screen. I don't have it right here. But there's a formula for calculating that one. 1 minus 1 plus r raised to power minus n over r. This is for what? Cumulative discount factor. You know, we can actually write 1, 2, 3 and spread it out. But since it's the same amount, constant cash flows, you just use this big formula. It's not big, but very small nonsense. This is, so just 1 minus 1 plus r, which is 1, r is what the rate, 0.1 raised to power minus 3 years over r, and r is 0.1. Okay, so when you do this, you get 1.1 raised to power minus 3 equals 1 minus answer equals divided by 0.1 equals, you get 2.4869. Okay, it is in your annuity table in your SFM. You don't need to learn this formula. This is the only one I used to learn, and it's the simplest formula in SFM, because they won't give you annuity table. They won't give you discounting factor table for they won't give you discounting factor table for a single year. It's very easy to discount once you know the rates, right? Once you know the rate and know the number of years that you are discounting to or discounting from. So the cumulative discount factor is this. If you get discount factor for year 1, you get something like 0.909. If you get for year 2, you get something like 0.8 something. For year 3, you get 0.7. By the time you add it together, you get 2.4, whatever. So that is what we mean by cumulative discount factor. And it is useful because of this 10. 10 will come in year 1, it will come in year 2, it will come in year 3. So instead of spreading it out, just say 10 times cumulative discount factor. Okay? Now, in year 3, there will be redemption, right? Redemption. You know, you just need to write what is happening here so that you prove to the learner that you know it. Redemption at what? At par. That is at 100 naira. Okay? So at year 3, you go and get the discount factor that you use to discount this cash to present value. Present value is what is the value of this 100 naira today? It's true that I will receive this 100 naira in 3 years' time, but let me know the value of it today. So present value is always less. That is, your discount needs to reduce the what? Because you know time value of money, that right? 100,000 naira today is not 100,000 naira in 3 years' time. So 100,000 naira in 3 years' time might be like the 70,000 of today. That's exactly the concept. All these things are real life situations, okay? So to get this discount factor for year 3, what you need to do is to use this formula, right? 1 plus 10%, the discounting rate raised to power minus 3. So 1.1 raised to power minus 3. You have 0.7513. Okay, now let's get the present values. Let me clean this one because I'll use this side of the board. Let's get the present values. Multiply. Just check out that video on my channel where I explained conversion from present value to future value. I explained it so you understand. So here you can see that there's an outflow here. This is when the investor gave the company the debt. This is when he was receiving interest, and this is where he was being paid back his money. It's very logical. When you multiply this by this, you have 74. When you multiply this by this, you have 24.87. If you multiply this by this, you get 75.13. I know because it's 10, is just shift the So you get the NPV here, right? Net present value. These are present values. Now Now let's get the net. So look at what I was saying, that when you tell the investor that investor, you will collect 100 naira in 3 years time, it should be at the back of his mind that 100 naira will collect in 3 years time is like the 75,000 of today. It's like 75 naira of today. So don't be too happy. That was how I learned it. So we have minus 74 plus 24.87 plus 75.13 minus 74 plus 24.87 plus 75.13. That will give you 26. Now, this MPV, the net present value, the gain on this investment is 26. Now, this is IRR we are trying to do, and don't forget that why we are doing all this drama here is to get these variables. Somehow, we already know that the lower discount rate is 10%. We know this one. The MPV associated with the lower discount rate is 26. We know the lower discount rate here, 10%. But what is the higher discount rate? What is the MPV of lower discount rate? We know that. What is the MPV of higher discount rate? We don't know. We don't know this, right? So this IRR is done by guessing. You are guessing, like extrapolating between your guesses. Something like that. You are trying to guess. So now you now guess a rate. This one too, this 10% is guessed, okay? You can use any rate, but it's good to always start from the coupon rate. Just take one thing that has been given to you, the question gave you. Now, because you have a positive MPV here, you will now look for, you think of a rate that will give you a negative MPV. And the rate that will give you a negative MPV must be a higher rate, okay? Higher discount rate. So because you have a positive MPV here, you think of a rate that will give you a negative MPV. Don't go and think of like 11% or 12%. Push it up. So what may I do is that I'll double it, like 20%. So now let's discount these cash flows at 20%. It will definitely give us a negative or close to negative. If it doesn't give you negative, don't now start sleeping in the example that it must give me negative, it must give me negative. No. If it gives something like 1 point something, and the supply is lower than 26, just continue, okay? But it's good to give it a lot of gap, reasonable gap, so that you can get your cost of debt. Your cost of debt can fall between that. Okay. So if you are discounting at 20%, you get your discounting factors, right? At 20% for year 0 will be 1.000. Year 0 is today, so 100,000 naira today, 100,000 naira today. But by year 1 to 3, discounted at 20%, right? We'll use our cumulative discount factor, or better still, use your annuity table. You might know that it will be 1.2 raised to power minus 3, 1 minus answer divided by 0.2. So I have 2.106. Now for year 3, the discounting factor at 20% discounting rate will be 1.2 raised to power minus 3. Straight up 0.578. 0.578. Let me see something like SFM. Most times the solutions should always be to 3 decimal places. Just after a decimal point, just leave 3. These are the ways to solve it. When I was in school, my lecturer used to put 4, so I'm so used to that 4. But in ICAN, 3 decimal places is fine. Now let's get the present value. So we multiply 74 times 1.1 will give us 74. 74 times 1 rather will give us 74. Then 10 times this will give us 21.06. 100 times this will give us 57.8. Okay, so we get your MPV minus 74 plus 21.06 plus 57.8. That gives us 4.86. You can see 4.86. Let's just say 5. In the exam, you think that's 4.86 and that's 4.86. But let's just say 5 here, so that I don't want too much decimals around me. So let's just say 5. You can see that if I push this thing up to, let's say 22% or 25%, this one will become a negative. But because it's not now negative, it's not the end of life, we use it like that. Okay, so it doesn't take this long, it's what I'm explaining. So let's put our variables into this formula. So we already have the MPV of the higher discount rate, that is 5. We already have the higher discount rate. Higher discount rate gives rise to what? Low NPV. Okay? And low discount rate gives rise to high NPV. It makes sense. See, when you are discounting at 10%, look at your discount factor here, 2.4. Look at it here, 2.16. If you multiply these two things by the same factor, this same 10, this one that you're multiplying this by this same 10, this discount rate will give you something higher than that. So, putting our variables, lower rate, that is which of the discount rate is lower? 10% plus NPV of lower rate, 26, over NPV of lower rate, 26 minus 5. This minus that is here is from the formula. Now, should in case you actually got a negative, let's say you got minus 3, put it there as minus 3. Then this minus minus will turn to plus. Do you understand? So you can press in your calculator that 26 minus minus 3 is to give the answer as 29. So don't say because there was one minus there and I'm joining another minus. The minus that is there is there. If you get a negative, put it there. But here we have a positive, so put the variable there. Okay? Now, higher discount rate. What is the higher discount rate? 20% minus lower discount rate, 10%. Check it now. So you saw the rule of BOD mass. Leave this one. First of all, dismantle this one into a particular figure and add it to 10. Right? This is multiplication. So in BOD mass, multiplication comes before addition. Right? So 20 minus 10 will give you 10. Finish what is in the bracket. This will give you 10%. Then this one, you have 26 over 26 minus 5. That's what? 26 minus 5, that's what? 21. Right? So you have 26 divided by 21. That gives you 1.238. So you don't need to write that one down. Multiply it by 10% straight. You have 12.38%. Add this to 10 plus 10. That gives you 22.3%. This is the IRR. IRR is the cost of debt. So for a redeemable and traded debt, the cost of debt is the same thing as the IRR. The cost of debt is gotten by determining the IRR. When you determine the IRR, you say cost of debt is equal to 22.3%. So can you see that the cost of debt here is greater than the coupon of 10%? 22.3 is greater than 10%. So somehow you know that you are correct. All these cost of debt there and cost of capital, cost of equity, they are actually estimation. There is no perfect answer. Somebody can get 22.7 or even 21.9. Do you understand? It's estimation. Estimating cost of debt. That's why sometimes the examiner will not even mark answers. They will mark the steps. They will mark your approach. They will mark your understanding. So you need to understand. You can't cram this stuff. You can't cram it at all. Please, if you have any questions, ask in the comment section. I want to solve another example on IRR, but this one took too long and I think you already understand. This one took too long and I think that we already understand it. So let me just go to another question. I want to start work tomorrow.